Let me start with a number that should honestly make you a little uneasy. $62 billion. That's how much net capital flowed out of the United States and into Canada in a single year. Not slowed down, not rotated sectors, it left. And what makes this even more alarming is that just 1 year earlier, the flow was going the opposite direction. Roughly $50 billion was moving from Canada into the United States. In 12 months, we didn't just stall, we reversed by over $100 billion. That is not a small market fluctuation. That is not normal volatility. That is capital voting with its feet. And when serious money starts moving like that, it usually means something deeper is shifting underneath the surface. If you own US stocks, if you're counting on the strength of the dollar, if your retirement is tied to American markets, you need to pay attention. Because capital doesn't abandon the world's largest economy without a reason. The real question is, what changed so fast that investors decided Canada suddenly looked safer than the United States? The turning point came in 2025 when the US launched aggressive tariffs that escalated into a full-blown trade conflict with Canada. What started as a policy decision quickly spiraled into retaliation, countermeasures, and months of escalating tension. Within weeks, long-standing trade stability between two of the most integrated economies in the world was shaken. But here's what's important. It wasn't just the tariffs themselves that spooked markets. It was the speed, the unpredictability, the sense that decades of economic cooperation could be rewritten almost overnight. Investors can price in bad news. They can adjust for higher costs. What they struggle with is uncertainty. When the rules of the game appear unstable, long-term planning becomes impossible. And when businesses can't plan, they stop investing. That's where the real damage began. Economist Paul Krugman described what happened as an uncertainty tax. It's not a literal tax you see on a receipt. It's something more corrosive. It's the invisible cost businesses pay when policy becomes unpredictable. When companies don't know whether supply chains will be disrupted, whether trade agreements will hold, or whether tariffs could double again in 6 months, they hesitate. They freeze capital spending, they delay expansion, they pull back. And that hesitation spreads. Suddenly, capital isn't chasing the highest return anymore. It's running toward the safest harbor. In this case, Canada's relative stability became a competitive advantage. Being predictable, even boring, became incredibly valuable. When money shifts for safety instead of opportunity, that tells you something fundamental has changed in the perception of risk. Normally, during global tension, investors rush into US dollars. The dollar strengthens because it's considered the ultimate safe haven. But this time, something unusual happened. Instead of surging, the dollar weakened. At the same time, gold climbed sharply, historically a sign that investors are hedging against instability. That reversal is important. It suggests that the uncertainty wasn't just geopolitical noise. It was tied directly to confidence in US economic stability. When global capital questions the predictability of the system itself, that's not a headline. That's a structural shift. And structural shifts are what move markets long term. One of the clearest warning signs showed up in foreign direct investment, what economists call patient capital. This isn't speculative money jumping in and out of stocks. This is the kind of capital used to build factories, expand operations, and create long-term jobs. Canadian direct investment into the US dropped dramatically, from roughly $46 billion to just $14 billion. That's not a pause, that's a collapse. Even more concerning, the data suggests it wasn't just fewer new projects. Companies began actively divesting, selling existing US assets, pulling out. That kind of move signals a long-term reassessment of risk. When long-term capital loses confidence, it's much harder to rebuild than short-term market flows. The damage didn't stop at investment data. Canadian tourism to the United States dropped sharply. Border towns, hotels, restaurants, and local businesses that relied on cross-border traffic felt the hit immediately. Billions in consumer spending evaporated. These are losses that rarely show up in headline tariff statistics, but they hit real communities hard. And then there's the impact on American households. Economists widely agree that tariffs function as a domestic tax. The added cost of imported goods doesn't magically disappear. It gets passed on to consumers. Estimates suggested the average American household absorbed roughly $1,000 in additional costs during the height of the trade conflict. That's not abstract policy. That's grocery bills, appliances, cars, everyday life. While the U.S. focused on raising trade barriers, Canada responded differently. Instead of escalating unpredictability, it pivoted towards strengthening domestic stability. New infrastructure initiatives were launched. Investment incentives were introduced. Efforts were made to diversify trade relationships and reduce dependency. Whether one agrees with those policies or not, the key point is perception. Global capital began to view Canada as the more predictable environment. In a world where trillions of dollars move based on risk-adjusted returns, predictability becomes a powerful currency. And that perception shift alone can redirect massive capital flows. This brings us to the most important question. Was this a temporary disruption or the beginning of something deeper? Tariffs can be reversed with a signature. Trade agreements can be renegotiated. But trust is different. Once companies relocate supply chains, once they commit billions to new jurisdictions, once investors mentally reclassify a market as higher risk, those decisions don't unwind easily. There are three potential paths forward. Tensions could cool and confidence slowly return. The two economies could drift into a managed separation, still trading but less integrated. Or, in the worst case, deeper decoupling could unfold, reshaping North American trade for years. History shows that economic dominance doesn't usually collapse overnight. It erodes gradually, through millions of small, rational decisions by investors adjusting for risk. That's what makes this moment worth watching.